Good morning, everybody, and welcome to our April Sustainability and ESG webinar. Now, I'm super excited today because I'm joined by my absolute favorite BDO partner, Kevin Frohbus. Kevin and I have been presenting together IFRS and corporate reporting webinars every month for the last 6 or 7 years. And finally, I've convinced him to also join me on these monthly sustainability and ESG webinar. So it's a big day. Welcome, Kevin. Lovely to have you here.
Thank you, Aletta. It's lovely to be here, and it's good to be on the sustainability path. I think the message is that it absolutely is entering the mainstream, and hence the reason why it was time to partner up on this webinar stream, as well as the financial reporting one that Aletta and I have been doing for some time. For those of you who don't know, Aletta and I will play off each other at some point, so just go with it for the ride, and it's good to be here.
Yeah, Kevin, it's really amazing to have you here. For me, I'm finding the webinars particularly hard if I'm the sole presenter because there's nobody on the screen that I can look at, and I just hope there's an audience out there. But this time, at least I can see you, Kevin, which is exciting. But thank you for, again, willing to, come and play with me on these webinars. Really appreciate it. We would like to begin by acknowledging the traditional owners of the land on which we meet today and pay our respects to elders past and present. And we extend that respect to Aboriginal and Torres Strait Islander peoples here today. Now, our presenters, I've welcomed Kevin and love to introduce Kevin. Kevin is an IFRS and corporate reporting partner. He's based in Sydney. He's also an advisory partner and also exploring sustainability reporting, carbon accounting. So, welcome, Kevin. The sustainability webinars, as you know, today we're looking at carbon accounting, what it is, why it's important. And then we're still going on a journey this year, next month, by setting carbon targets, developing a decarbonisation strategy, looking at the role of voluntary and mandatory sustainability reporting, etc. So we're looking at a number of aspects that collectively make up sustainability. So that's the journey, and you can see it's already the 4th webinar for 2024, and it's the 3rd year we're running these sustainability and ESG webinars at BDO. Then Kevin and I are also running some carbon accounting masterclasses, and we would love to invite you to join us. So Kevin and I will be presenting the one together in Sydney on Friday, the 24th of May. But I'll also be traveling to Adelaide, Brisbane, and Perth, and we'll do a virtual session in June. So please feel free to register, reach out. It will be a whole day session where we unpack carbon accounting. We look at boundary setting. We look at scope 1, 2, and 3 emissions. We'll have practical case studies, share experiences of what we've seen to date. So please join us. Now, this is the webinar series that Kevin and I have been doing for the last 7 years. And I've put in red there the next one. And that is on the 22nd of May, we are presenting our update on financial and sustainability reporting, preparing our clients for 30 June 2024 reporting. That particular webinar, the May one, when we get ready for 30 June, over the last 7 years, that's been the showstopper, the most attended webinar every year. So your finance team or you might be interested in that particular webinar. So please join us for that one. It's not just IFRS accounting standards. We'll also look at what sustainability reporting might look like in 30 June financial statements. Now, today's agenda, fairly short. First of all, we're going to start by looking at the latest developments around final legislation that's been tabled in Parliament. Then we look at a new age in sustainability, entering a new age of sustainability. We're going to share some research from our US firm. Then we go to, what is carbon accounting? Why is it so important? Why we go on and on about carbon accounting? And finally, how BDO can help. So latest developments, final legislation tabled in Parliament. Now, this is an interesting one. Our previous sustainability webinar was presented on Wednesday, the 27th of March. And that morning, we were talking about sustainability roadmaps, and we were talking about draft legislation that was tabled in January, and that we would only expect final legislation, let's say, by June. However, that same afternoon at around 4:15, we received information that the final legislation was tabled in Parliament. Therefore, I would like to start with that and give you an update on that final legislation. So we know at the beginning of the year, very early on the 12th of January, government released their draft legislation, and it had a few new things in it. It introduced a separate sustainability report. So we don't have sustainability information in the operating and financial review part of the director's report. No, a separate sustainability report, number one. Secondly, it's part of the annual report. So although it's a separate sustainability report, as in separate to the financial report, it's still part of the broad annual report. We also heard that assurance would be required from day dot, and also that assurance will have to be provided by the financial report auditors. And yesterday I attended a round table with Doug Nevin, the chair of the Auditing and Assurance Standards Board, and the question was asked whether that financial auditor should be the same person auditing the sustainability report and the financial report, or whether it's just the same firm. And that's still to be decided. So we couldn't get an answer. So that's still up in the air. So I just want to flag that as well. That's one of the things when we looked at the legislation in January, we were concerned about. We raised it in a comment letter, and Doug yesterday confirmed that it's not been resolved yet. So this is what happened in January. And then that Wednesday, just before Easter, I say happy Easter because on that Wednesday, the 27th of March, Australian government followed on its promise to mandate climate reporting in Australia, and they've introduced the Treasury Laws Amendment Bill into Parliament, and the bill mandates climate reporting. So not all sustainability reporting, but climate reporting for entities required to prepare and lodge financials with ASIC under Chapter 2M of the Corps Act. But I suppose the good news is that the bill delayed or delays the start date for Group 1 entities by at least 6 months. So where we thought that Group 1 entities based on draft legislation will have to prepare the mandatory sustainability reports as part of the annual report for years beginning on or after 1 July 2024. It's been pushed out for years beginning on or after 1 January 2025 at the earliest. It might be a bit later, which if you've got a 30 June year end really means it's no longer 30 June 25. It would now be the earliest 30 June 26. So that's a significant change that happened the same day that we had our previous webinar. And I've got a link in there to the article we've published the following day and we've circulated to clients. So this final legislation did not change who will be required to begin with climate-related reporting. So it still has 3 columns. There's the first section is looking at large entities. If they meet 2 of the 3 criteria, you could be in Group 1, 2, or 3. So that didn't change. Group 1 is still more than 500 million consolidated revenue. At the end of the year, you've got more than $1 billion of assets or more than 500 employees. If you meet 2 of those 3 criteria, you would be Group 1. The second aspect to consider is if you're an ENGA reporter, if you're above the publication threshold, you would be Group 1, irrespective of what happened on the large. And if you're just a normal ENGA reporter, but not above the publication threshold, you would be Group 2. And then asset owners, they've clarified in the final legislation that asset owners, that section is only relevant for super funds and managed investment schemes. So if they've got more than 5 billion assets under management, they would be group 2. So it's specific rules for very specific types of asset owners. For most entities, they wouldn't consider that particular column. So final legislation confirmed this and maybe clarified what do they mean with asset owners. Now, this is the key thing that happened. And I've got a link there to the article. What they're saying is, maybe I should start by this. Nothing is changing for group 2 and group 3 entities. Whatever you thought your initial mandatory reporting would be, that's not changed. So on the right-hand side, group 2, group 3, really doesn't matter what the official start date is. You will only be looking at 30 June 27 for group 2 and 30 June 28 for group 3. However, for group 1, there's a number of alternatives. In that second column, I've put this was the previous exposure draft. If you had a 30 June year end and you look at the previous exposure draft or that draft legislation, the first year would have been 30 June 25. However, if you look at the next column, if this legislation moves through both houses of parliament before the 2nd of December this year, then the start date will be 1 January 2025, so years beginning on or after 1 January 25, and therefore for a 30 June year end, it would be 30 June 26. However, if the legislation is not approved and goes through both houses of parliament before the 2nd of December, but it goes through before the end of May next year, the start date will be 1 July 2025, which means, again, for 30 June year ends, 30 June 27, 30 June 26. So what you can see here is most likely for group 1 entities, the first year that the 30 June year end entities will be applying this mandatory reporting will be 30 June 26. Group 2 doesn't change, 30 June 27, and group 3 doesn't change, 30 June 28. What's really happening here is group 1 entities get an extra year if they've got a 30 June year end. However, we also wanted to articulate what this means for entities with a 31 December year end or 31 March year end or 30 September year end. Because interestingly, if you look at entities with a 31 December year end, based on the draft legislation, they would have said we have to get ready for 31 December 2025. If the legislation goes through before December this year, they would still be looking at 31 December 2025, which I think is the most likely time frame. However, if legislation only goes through Parliament in next year or early next year, they will get an extra year and it will be 31 December 2026. So actually, I think the expected impact for 31 December year ends is nothing different to what we thought previously, but for 30 June year ends, there's an extra year. So this is just a diagram to bring it all together. The legislation, the final legislation, and how these start dates work has been drafted quite in a complicated way, and that's why we try to explain it in a table. If you've got any questions on when this might impact your business, please reach out to Kevin or I, and we can help you with that. It is complicated, and there is a link to the article where we've explained it and try and clarify. So really, as a recap, what they're saying is when we mandate sustainability reporting, this is what it would look like in your annual report. You'll have an annual financial report, you'll have an annual sustainability report, you'll have a director's report, and you'll have an auditor's report. That financial report will be your normal financial statements, notes to financial statements, and a director's declaration. And the audit report would relate to the financial report. And then for your sustainability report, you will have climate statements, notes to the climate statements, a director's declaration in respect of those climate statements, and you'll have a review report, limited assurance, over those climate statements and sustainability reports. So this is what the final legislation is proposing. I did think it would be a good time to maybe have a little bit of a look of what they are including within these climate statements. Because a lot of times people think it's only carbon footprint, and it's actually a lot more. Globally, they've issued IFRS S2 climate-related disclosures, and this is the one that the AASB is currently making some small amendments to. We're hoping it's small, to get to Australian sustainability reporting standards. But at a high level, these are the things that they would like you to disclose in your climate statements. It's all about governance. So those charged with governance, who's responsible, and also at a management level, who's responsible for climate. Then they go to a strategic pillar, and there we've got what are your climate-related risks and opportunities? What are your physical risks and your transition risks? What are the effects of these physical and transition risks and opportunities on your financial statements? So making it real, what is the impact, or what impact does it have on the value of assets and liabilities, income and expenses? And then also, please tell us about your climate resilience. And in particular, how resilient is your business model? How resilient is your strategy to deal with these climate risks and opportunities? So business model, strategy, to what extent can you deal with climate risk and opportunities? So that's all part of strategy. Then there's a whole pillar around risk management. And it is saying, look at your processes, your policies that you use to identify, assess, prioritize your risks. Now, I just want to flag here, I'm going to talk about risks very shortly and the research we've done around ESG risks. So risk management is a particular pillar that will be expected to be disclosed. Then they want you to disclose climate-related scenario analysis. So at least 3 different scenarios. And if you look at global warming, the 3 different scenarios that could impact climate change, impact your physical risk and your transition risks. And then, very important, they would expect this risk management to be integrated into your overall risk management process and risk register, and disclose how you do all of that. Then finally, we get to metrics and targets, the 4th pillar. And here it is, what is your carbon footprint? Scope 1, 2, and 3. How targets have been set. So how did you set targets? How are you tracking or progressing against those targets? And in order to meet your targets, if you're not reducing your carbon footprint, will you use carbon credits? Will you be buying carbon credits? So how does all of that work? These are the headings required by IFRS S2. You have to look at governance, you have to look at strategy, you have to look at risk management, you have to look at metrics and targets. And I've tried to give you a little bit of a flavor of all the information that will have to be disclosed in these climate statements. So if I go back to here on the right-hand side, what will be in this mandatory sustainability report in your annual report? There will be climate statements. There will be notes to climate statements. And then if you say, Aletta, what are these climate statements? The climate statements will deal with governance, with strategy, with risk management, with metrics and targets. And the notes will expand on all these aspects. Disclose your methodology, disclose your estimates, disclose your judgments. All right, so this is extensive. Let's make no mistake. Now, I've previously shared it with you, and I'd love to share again. Your carbon footprint could look something like this. But remember, carbon footprint is one of the things under metrics that you'll disclose. So this is just an example of a one little bit of IFRS S2. So that's your carbon footprint. And then there could be notes to your carbon footprint. What is your methodology? What are your estimates? What are your assumptions? So again, I want to articulate carbon footprint and all the relevant notes is one part of IFRS S2. IFRS S2 deals with a broad range of aspects across governance, strategy, risk management, metrics, and targets. Very important, we've said there, IFRS S2 would like us to and is mandating us to consider the financial impacts of climate-related risks and opportunities. Now, this is an extract from the TCFD recommendations. The best one I've seen linking transition risk opportunities to financial impact. So if you look at our transition risk, there are policy and legal risk, technology risk, market risk, reputation risk. There are physical risk, acute and chronic. All those risks impact your strategy, your risk management, and ultimately the numbers in the financial report. And the same with the opportunities, the resource efficiency, energy sources, products, services, markets, resilience, all those opportunities impact your strategy, impact your business model, impact your risk management, and also then the numbers in the financial statements. So ultimately, we cannot have a financial report in the annual report and a sustainability report in the annual report that are completely disconnected. The sustainability information have to impact the numbers in the financial report. It's called integrated reporting, and that's what we have to try and achieve here. So really important that you look at this holistically. That's what IFRS S2 mandates. It's not optional. It mandates it. Previously, I just wanted to complete the circle. Previously, the draft legislation talked about some modified liability for directors because there were concerns about scope 3 emissions and certain climate-related forward-looking statements. And there were suggestions of let's have a 3-year period where the regulator, ASIC, can take action, but they can't take action against the company, but action can't be taken against directors for those aspects. In the final legislation, they've changed it a little bit. So they're now talking about immunity provisions. So they are saying there in the third bullet point, in addition to covering statements about scope 3 emissions and scenario analysis for the first 3 years, the limited immunity provisions for directors have been expanded to include statements about the entity's transition plans. So if you've set a target and you then need a plan to show how you're going to go from your baseline emissions to your targeted emissions, that transition plan, that is now also subject to limited immunity provisions. Also, second last bullet point, that drop dead 30 June 27 end date for the limited immunity provisions or that modified liability, that has been removed, and that limited immunity provisions now applies to financial years commencing during the first 3 years from the start date of the legislation. So we have to determine when is the start date of legislation, and if your financial year is starting within 3 years of that start date, it will be captured. It will not be for 3 years, but it could potentially be for a year or two within that period. And then the last one is really interesting for us here at BDO, Kevin, in that further immunity is provided for protected statements during financial years commencing during the 12 months from the start of the legislation, for forward-looking statements, and that immunity for protected statements also relates to the auditor's report. Previously, there were protected statements for directors, but now it's extended to auditors, because we know ultimately the directors are responsible for the disclosures in a financial report and a sustainability report. Yes, the auditor come and do an audit, a financial report, or provide assurance, but responsibility is still with directors. If directors are getting some limited immunity provisions, our comment was, what about the auditors? So that's a bit of an update on the latest legislation. And I know previously we've talked about a best practice roadmap for Group 1 entities. And what we've done here, we've updated that best practice roadmap for Group 1 entities based on this final legislation that's been tabled. So you'll see for 30 June 24 and 30 June 25, so this is for 30 June year ends, we now have an extra 12 months to get ready for that Scope 1 and Scope 2 emissions that will be mandatorily reported 30 June 26. We have an extra 12 months to get ready for Scope 3 emissions, but please don't wait, it's a nightmare. For climate-related disclosures for 30 June 24-25, you know, the TCFD recommendations are amazing stepping stones to get ready for IFRS S2 and for Australian sustainability reporting standards. So, you know, again, we would encourage people to look at TCFD recommendations, do an IFRS 2 gap analysis, identify the projects they have to run to get ready. And then again, for a strategic focus, again, you know, start that strategy, consider the strategy and what that would mean for your business. So it's an updated roadmap. So initially, I just wanted to update you on the latest legislation and how that might impact your business. In the second, Kevin, yes.
Could I just make an observation? And that was a wonderful update. Thank you. The observation I'd make is listening to all that, and for those on the webinar, this is not going away. And I think that it became clear to me in the last 3 or 4 weeks that any hope we had of the Group 3 entities being delayed till another year or is all evaporated. Government is pretty serious about moving this forward. But I do want to kind of bring it back to Aletta's timeline that she had on the very slide just before this one about the timeline. The one metric that we know is going to be mandatory for everybody is the carbon footprint measurement, which is obviously the purpose of today's webinar. And if you don't know where to start with strategy and risk and all that stuff, at least start measuring the carbon footprint, because what gets measured is what gets managed, and that is actually the purpose of this. The purpose of this is, if you don't know where your emissions are coming from, you can't do anything about them, and that's the idea. And taking it all away, if you had to break it all down to its bare bones, it's time to start at least measuring your carbon footprint immediately. If you're a Group 1 entity, you've got to do a whole lot more because your time is short. But for some of those entities that are further down the path, start with the carbon measurement footprint, because you can start to see where your emissions come from, and then you can actually start to build the rest around it.
And that is an important part of your strategy then, Kevin. Thank you very much, Kevin. Then in the second section, just this week, BDO in the USA issued a publication entitled Entering a New Age of Sustainability. And it is a risk and ROI survey, or return on investment survey. Is that the correct terminology, Kevin? Where they've looked at surveying entities, more than 600 entities, and getting their feedback. This was done in 2024, just released. So I wanted to share this. And it's surveying CFOs in particular. And what they're seeing there is that CFOs see the growing role, see the growing role of ESG as ESG strategies mature. They've said companies embedding sustainability into their overall business strategies are better positioned to drive value and enhance resilience. And we've talked about resilience, how resilient is your business model and your strategy for climate risk. And here we've got this enhanced resilience. So you can download this report and read it in detail, but I've captured a few extracts that I want to share. So they talk about why ESG strategies are evolving and how CFOs are integrating their business and ESG goals. We've always said that ESG cannot be a separate initiative. ESG has to be integrated with your whole business and your bigger business strategy. There's a discussion around the critical role of the CFO in their organization's sustainability and ESG efforts. And, absolutely agree. It's important that the CFO is on this journey, looking at systems and processes, managing the risk. And then there was also emerging ESG issues associated with generative AI, along with some recommendations for risk mitigation. So these were the high-level things. So they talk about entering a new age of sustainability. And what was interesting here is they've said here, survey respondents report shifting their focus over the last year beyond regulatory mandates, building ESG programs that improve risk management, competitive advantage, and strategic resilience. They've embedded sustainability and ESG factors into their overall operating and growth plans to the benefit of their businesses, their workers, their stakeholders, and the environment. And then interesting, driving sustainable value is a long-term game. But some companies are also seeing immediate impacts on their talent pipeline and their workplace culture. So I think this was really fascinating feedback from the survey. Maybe some of the key takeaways from this risk survey. ESG programs are maturing. 53% of CFOs say they've embedded ESG principles into their core business strategy or are actively working on it. And then they also say the second one, CFOs will have a stronger hand in sustainability strategy. So 3/4 of the CFOs expect their involvement in strategic ESG conversations will stay the same or even increase in future. So this is on the radar of the CFO. Tax credits may be overlooked in sustainable financing strategies. And then just over 1/3 of CFOs are taking advantage of tax credits in a particular year. So that's fairly low. And, in Australia, if you speak to our R&D tax partners, if you are doing a lot of innovation to embrace sustainability, consider the R&D tax incentives. Then ESG risks are here to stay. 61% of CFOs anticipate ESG risk will increase or stay the same in 2026. And then again, the comment around generative AI, 52% of CFOs cite either a social or governance risks as their top generative AI related concern. Again, very interesting. If you look at the ESG programs in general, if you look at your ESG program maturity has increased. 33% would say that their ESG programs are mature, 67% reactive. That was in 2023, and in 2024, 53% would say their ESG programs are now mature, and 47% will say it's just reactive. And that's a big, huge shift, actually. And if you look at that ESG maturity by industry, again, you can see if you look at ESG being a mature program, highest maturity in manufacturing, 59%, in manufacturing and healthcare, energy 57%, life sciences 56%, technology 48%, and retail 38%. So that's the percentage that they would rate whether their ESG program is mature or reactive. The other one that's interesting, the most reported objectives for ESG initiatives. Number 1 is improve brand reputation. Number 2, to attract and retain talent. Number 3, to improve employee engagement. Number 4, to access sustainable financing. And number 5, to improve ESG rating. So strategically, this is why entities have embraced on ESG initiatives. Number 1, to improve brand reputation. And then also on the right-hand side, there's some changing objectives for ESG initiatives by industry. The middle column is looking at the top objective for every industry in 2023. And then in 2024, on the right-hand side, the top objective in 2024. So you can see the top objectives for 2024 for many of these industries, it's attracting and retaining talent or improve brand reputation. And we've got it there by industry for you to have a look at. Again, I think fascinating results on how it's changed. 2023, often it's about, we want to embed the strategy, we want to manage our risk and our compliance, etc. In 2024, it's now about attracting, retaining people, improving our brand reputation. Some of the recommendations that came out from that was, number one is evaluate your opportunities. Link your ESG priorities to opportunities that create differentiation, efficiency, and growth across the organization. So don't overlook opportunities. Don't just focus on risk. Also consider the opportunities and how it can help you attract and retain people and boost your brand. Number two is stay focused on what's most material. We do a materiality assessment for a reason. If your stakeholders are telling you this is what's most material, that's what we have to focus on. Make sure that your sustainability strategies reflect the needs and the mission of your unique business and the stakeholders. And the third recommendation is create shared ownership. Interesting. Bring the finance function together with other core departments like tax, like internal audit, HR, enterprise risk management, and create a unified strategy and measurable goals. I absolutely love that, because when we work with clients, Kevin and I are seeing that it's only organizations that bring all these people together, that go on a joint journey across the whole business, working collaboratively together, that have real success. But important, bring the finance function together with all these other departments. I still believe the finance function, the CFO, needs to drive this, because it's going to end up in the annual report. It's going to be subject to assurance. The other thing that's interesting is there's been a real focus, and they've asked questions around finance council on sustainability matters. So this is basically looking at the role of the CFO. And the first sentence there is, with the rise of the Chief Sustainability Officer, does the CFO still have a role to play in sustainability and ESG strategy? That's the question. We have this Chief Sustainability Officer. What about the CFO? Are they off the hook? Do they still have a role to play, the CFO? And the answer is yes. Even as more companies appoint designated sustainability leaders, finance leaders are more vital than ever to their organization's sustainability and ESG efforts. And I think that's really, really important. 3/4 of CFOs actually expect their involvement in strategic ESG conversations to stay the same or increase in the next 12 months. Only 3% of CFOs say they're not involved in ESG discussions. I mean, that is really telling. And there's a quote from Karen, who's our global sustainability leader at BDO. The finance leader's purpose goes far beyond ensuring ESG reporting and compliance efforts are timely, complete, and accurate. With a broader strategic perspective, CFOs often serve as a catalyst connecting, balancing new growth opportunities and risk-driven imperatives across a wider set of stakeholders. Kevin, I know you've presented a number of webinars across. The CFO is now the Chief Value Officer, and this survey and research, again, further supports that. So if you look at the CFOs, do they expect their involvement in these conversations to increase in 2024? If you look at it by industry, in technology, 55% say yes, it will increase, retail 46%, etc. And then also a bit of research, is this different? Is the CFO's role different, whether it's a private company or a public company? So private company, 45% say their involvement will increase, and public company 36%. So even more important for a private company. Some of the recommendations out of that. So this is recommendations across or aimed at CFOs and their roles. So first of all, actively participate in ESG conversations, evaluate notification mechanisms, assess existing communication and feedback channels. How effectively is the finance department or the finance team kept apprised of ESG related updates from regulators? So make sure you know what's going on. And then also, as a finance team and as a CFO, take these ESG initiatives and turn it into tangible cost savings. And then again, some stats around ESG risk levels by industry. CFOs see ESG risk evolving, not disappearing, and 61% of CFOs say sustainability and ESG risk pose the same or greater business risk this year as 1 year ago. And again, some recommendations. Don't wait to prepare for ESG disclosure mandates, so be proactive. Increase the frequency of ESG risk identification exercises. Remember, IFRS S2 requires you to disclose a lot of information around risk management across the business and climate-related risk, and then create enforcement processes. So develop robust risk monitoring and enforcement mechanisms. So that's recommendations aimed at risk professionals in particular. And I really like this. There's also a separate article I found written by Karen on the CFO's role in ESG. Few roles are better positioned than the CFO to motivate, mobilize an organization to adopt new behaviors and embrace change. Leading by example is key. CFOs need to embed ESG into their own decision-making processes. So finally there, for ESG strategy to transform from vague values to tangible action, CFOs need to take the lead. And this is a real call to action for CFOs. So first of all, I wanted to, as always, give you an update on all the latest developments that's happening globally, but also in Australia. So what is carbon accounting? Now, last year we had 6 webinars where Dylan Byrne and I talked about carbon accounting, measuring your carbon footprint. So today is really a very high level recap. What is carbon accounting? When people talk about carbon accounting, are they talking debits and credits in the general ledger? The answer is no. Carbon accounting is just a process to measure in carbon dioxide equivalent the amount of greenhouse gas emissions that an organization produces throughout their entire operations and supply chain. So carbon accounting is a measurement, a calculation exercise. And yes, IFRS S2 would like you to disclose these numbers, but carbon accounting is not a debit and a credit in your general ledger, and you won't see it in your trial balance. In Australia, the National Greenhouse and Energy Reporting Act 2007 provides the framework for measuring your carbon footprint. And globally, the Greenhouse Gas Protocol is highly respected, used by most organizations, and also mandated by IFRS S2 globally to measure your carbon footprint. In Australia, currently the exposure draft will be apply NGA Act as far as possible. NGA only deals with scope 1 and 2. And then when you cannot apply NGA anymore, then you go to the Greenhouse Gas Protocol for scope 3, for example. So if we look at carbon emissions, if we have to measure carbon emissions, we have to measure direct emissions in scope 1 and indirect emissions, scope 2 and scope 3. Scope 2 is a special category of indirect emissions because it's looking at purchased electricity, mainly in Australia. I just want to put this out there. When Kevin and I have a look at measuring carbon emissions, we start with boundary setting. It's the foundational step on which the remainder of that entity's carbon footprint is based. It defines specific inclusions and exclusions from the measurement. If you rush to capturing data and doing a calculation, you rush to scope 1 and 2 or scope 3, you're going to get this wrong. So Kevin and I often work with our BDO auditors when they go and do assurance over a carbon footprint. And the first thing we ask for is, can we please get the boundary setting document? Can we please see the methodology, the basis of preparation? And a lot of entities have rushed past that. So I cannot overemphasize boundary setting, and we'll discuss that in great detail in our masterclass. Then you go to scope 1 and 2, which it will be mandatory reporting in the first instance, and then scope 3 a year later. And then there's a process. We start with our boundaries. You can see here, step 1 is determine boundaries. Step 2 is identify the sources of emissions. Then you select your calculation approach accordance to the ENGA Act or Greenhouse Gas Protocol. Only in step 4, can you see that? Only in step 4 do we collect data and choose emission factors. Then we apply calculation tools, and then we roll it all up at a corporate level. Very important, today we were saying, why is carbon accounting the thing? And I want to link it back to the webinar we had in March. There's usually 2 reasons, and it's sometimes it's a combination of why carbon accounting is important and why it's important now. It could be a strategic imperative, or it could be a compliance imperative. The strategic imperative, it's all about access. If you want to have access to capital, often your investors, super funds, owners, providers of debt capital want to know what your carbon footprint is, whether you've got a target, do you have a transition plan, how are you tracking? The same with markets. Customers are increasingly asking organizations, not for all the other things, but they start with, just tell me, do you have a carbon footprint? Have you set targets? How are you tracking? Do you have a transition plan? This is the first point. This is where they start. And then people want to know, your own people, what you're doing. So carbon accounting is important now because it's important for you to understand where you fit into this economic system. Who are your investors, financiers, your suppliers, your customers, employees? What are they demanding? And I'm telling you what they're demanding at the moment from all angles, the pressure from all angles on your business in the first instance is around carbon. It will extend to other areas in future, but at the moment, it's all about carbon. And then the other thing is, why should we seek assurance over a carbon footprint? Because you have to provide this carbon footprint to all the people in your ecosystem, and they want to know that that carbon footprint is credible, it's trustworthy, and it meets their needs. And therefore, assurance is the way to go. The other imperative is a compliance imperative, so that's regulatory activities. Now, we know the ISSB issued IFRS S1, S2, but what happened in Australia, we've got the final legislation tabled on Wednesday, I think it's the 27th of March, not the 28th. And then also we have the Australian Sustainability Reporting Standards. We've got an exposure draft on what that would look like. And this is the best practice roadmap that we've put out for Group 1 entities with a 30 June year end. So there's regulatory pressures on the way. The green blocks is when this will be mandatory in Australia. But I also want to flag that on the 23rd of April, this was published. that is just yesterday, the ASIC chair made a presentation or a speech about start preparing now, early ASIC guidance on the mandatory climate disclosure regime. And I've got a link there to his whole speech. But the key thing here is ASIC is saying, although we've got this timeline that's been pushed out by the final legislation, and although 30 June entities don't have to be ready for 30 June 25, but it's now 30 June 26, please don't wait. You've got an extra 12 months, so get started. So I flagged a few things. He said in his speech, nearly 75% of the ASX 200 have committed to or already voluntarily reporting climate-related information against the TCFD framework. So they're starting with the TCFD framework as a stepping stone to mandatory reporting under IFRS S2. 75% looking of the ASX 200. Remember, all those entities, if they are within your investor community, customer community, supplier community, pressures in your ecosystem, they will start to get some or ask information from you, especially around carbon. He also said it's simply not an option to put this off until after legislation has passed and then scramble to comply. So if you're driven by compliance, don't put it off. It's a huge job. But also remember that these entities that are already on the journey will increasingly ask you for information. TCFD will be well placed to report under any future mandatory reporting regime. Entities that are already looking at the TCFD recommendations will be well placed to report under new Australian standards or IFRS S2. So while companies may continue to use this voluntary TCFD framework, they may also start to look at an ISSB gap analysis, and Kevin and I are doing many of those at the moment. So Kevin, at this stage, I might hand over to you to talk about these TCFD recommendations, but very timely that even ASIC came out yesterday and said, listen, TCFD recommendations is the way to prepare for Australian standards. It's the way to prepare for IFRS S2. So there's a strong push for these TCFD recommendations for 30 June 24 and 25.
Yeah, thanks, Aletta. Look, I'll only have a few general comments to make. I think if I had to bring it all down to this one point from the stuff you've just mentioned, I think it can be overwhelming if you're walking into this place in the first instance. There's a lot going on, and the standard setting in Australia, I want to say, is taking the last 10 and 15 years in the rest of the world and cramming it into a very short space of time in terms of making it available to the public, making it compliant in the corporations legislation, giving us a deadline for compliance. So essentially what the rest of the world has been doing in 15 years, we're suddenly going to have to do in 2 or 3, and for Group 1 entities, really you only have about a year to do it. And so bringing it back together, there's really 2 legs emerging here. For those of you who are really just starting or don't know where to start, 2 things that kind of dropped out for me in the last few months, and that is break your carbon footprint measuring down to a work stream and focus on that in the first instance. And I'll talk a little bit about more that in a short while. And then create a stepping stone strategy to IFRS S2, or the version of that that's going to ultimately be in Australia. And that's where we come to the TCFD recommendation is your stepping stone. The reason why I'm going to talk about it is because the TCFD recommendation is very much that. It was the precursor to everything else that we're going to have to comply with, like IFRS S2 or the ASRS standards in Australia once they become finalized. And if you start with TCFD, you could almost do it as a stepping stone, because it's very qualitative in nature. It sets these principles, these disclosure principles to disclose by, which basically said, can you describe your governance processes around climate risk? Can you describe your process around setting risk and opportunity? Can you describe how that feeds into a strategy? And can you describe how you're building your metrics and targets up? It's not as overwhelming as IFRS S2 or the Australian equivalent, because when you look at IFRS S2, there's pages and pages and pages and pages of disclosure requirements, and honestly, you don't know where to start. In fact, if you've actually read the standard, gold star on your forehead, because I think sometimes if you really don't know where to start, it's actually to start reading something. And I would say start with TCFD, because TCFD takes you on a journey about, can you actually describe these things? I want to say that when you look at this diagram, it's talking about governance strategy, risk management, and metrics and targets. I actually started metrics and targets, and I kind of feel like that's where you should start as well. You can see it's actually the little circle at the bottom. Why? Once again, I like to encourage you that if you don't measure it, you can't identify risks, you can't build a strategy around it, and you can't build a governance framework around it. So identify first your metrics and targets, but it's not just scope 1, 2, and 3 emissions. Lots of energy companies measure things that relate to the natural environment. So if you're measuring something, or if you're monitoring something and it relates to water or air pollution, or even just complying with some sort of disclosure to a regulatory body around how much solvent you're putting into the water in terms of discharge, those are all metrics and targets that relate to the natural environment, and that's your starting base. So starting base in terms of TCFD recommendations, we know that carbon is going to be mandatory, so you're going to have to start to build that. But don't lose sight of your other inventory of metrics and other targets, because every organization has some sort of metric or target in terms of the way they interact with the natural environment. And that inventory can then form your risk management process, which drives your strategy and governance ultimately. So start with TCFD. It's a lot more descriptive. It challenges you to be able to describe things as opposed to a checklist of items. And these 11 recommendations on the screen now, these are the ones you can see. It's all describe your board's oversight, describe your management role, and essentially, if you can't describe these things and you can't articulate it, then you know that that's your area of focus. And once again, look at the bottom right-hand corner, and Aletta's going to push her slide. She's going to click enter, and a little circle is going to appear. Even the TCFD has scope 1, 2, and 3. It's the base mandatory measure or metric that everyone's going to have to do going forward. The other thing I want to just comment on scope 1, 2, and 3 is, if you're struggling to break that down, scope 3 is the hard one. There's no doubt that scope 3 is hard. Why? Because you need to identify your emissions essentially along your value chain, your upstream and downstream emissions. And honestly, most organizations can't even pinpoint where their upstream and downstream processes are. Sometimes they don't even know where the supplier gets their raw materials from in Asia or China or Europe. And so actually understanding the reach of your value chain can really be hard. But if you start to scope 1 and 2, which is step 1, do that first, and more importantly, do your organizational boundary and operational boundary setting. Why is that important? Because it's also a qualitative process to a degree, not exclusively, of understanding where your sources of emissions are. So it's really like doing an inventory. Where is this all coming to? And if you break it down to, can I describe these 11 recommendations, and can I define my boundary for scope 1 and 2? Then if you do those two things first, it's a good win before the end of June 24. And that would really be your starting point. So I think I'll kind of leave it at that, Aletta, in terms of this. There's a couple of things in terms of where the TCFD is. The TCFD has essentially been disbanded, but you can find it still all on the internet. It's all still there, all the uploads and context. Why has it been disbanded? Because it's been rolled into the IFRS S2 standard. So ultimately, it was the stepping stone to the standard setting. So then why wouldn't that be your stepping stone to how you implement it? And that's really the message. So there's a couple of slides on here. I think it's a bit of homework for yourself to go and have a look at. There's lots of studies about how other entities have implemented this in the first instance. I actually think there's a diagram on here about disclosures that have actually been made in accordance with the TCFD. You can see where entities have focused their attention, and you can see in this diagram that if you take those categories that have been listed, notice that the scope 1, 2, and 3 emissions at the bottom has pretty high level of disclosure because entities would start there. Notice that governance is also quite high, and metrics, because what is measured is managed. But notice that the strategy and the risk management is quite
Yeah,
poorly disclosed. Why is that? Because you need to, first of all, integrate the metrics and the governance into a risk management framework, which ultimately leads to strategy setting. You can't do that all in the first year. You can't even do it in 3 months. It's a journey. And if you take yourself on a journey, then those disclosures will come later. Now, bearing in mind this status report that's on the screen now, which shows disclosures of TCFD aligned disclosures of a sample of companies, was probably when a lot of those entities had the ability to voluntarily report. Australia doesn't have the luxury of voluntary reporting. We're going straight to mandatory reporting over a very short period of time. And so there's no time to waste to start to build up this disclosure. But the reality of it is that your strategy and risk and your risk management will take time, but you got to start somewhere. So start with your metrics, get your governance frameworks in place, and build yourself up to the end degree. I think, Aletta, I'm not really sure what the next slides are in this pack, but I think with 12:02 on the time, I might call it time on the
yeah.
TCFD and leave it at that.
Kevin, what I thought I'll do, I just wanted to flag that we have prepared a TCFD checklist that people can download from the website to try and practically assist them with the TCFD recommendations. So it's a short checklist. It's got some explanatory material, so please feel free to download. Also, if you want to understand a little bit more, we've got a free introductory e-course on the TCFD recommendations, just giving you context, what it's trying to achieve. So you don't want to jump straight to the disclosures, but do a bit of learning, or maybe learning for your team. You could do that as well. So a checklist and e-learning. And then how BDO can help. As you know, Kevin and I do, and Dylan Byrne, the three of us do carbon accounting. We also have a team, Kevin and I, and Brett Spicer look at sustainability reporting. Brett looking at the voluntary reporting more, and Kevin and I at the mandatory sustainability reporting, IFRS S2, TCFD recommendations. That's what we do as IFRS experts. And then also a number of people across BDO Australia looking at sustainability decarbonisation. I'm thinking Christy Porter in WA and Justin Harness in Sydney, with Kevin, Brett Spicer in Brisbane, and then I'm also looking at that from a Melbourne perspective. If you are looking for assurance over sustainability information, remember in future it will have to be whoever is the auditor of your financial report. But if it's a completely separate sustainability report, and at this stage you need assistance, please reach out to our BDO auditors as well. There's some additional information around all of those. What do we mean by carbon footprint, sustainability reporting, and strategy? And these are the people that provide these services. So please feel free to reach out to us. We would love to help you. We also do a little bit of work on sustainable finance, etc. We have regular insights. Our sustainability insights went out, or newsletter went out last Friday. Corporate reporting insights went out on Thursday. And we also have webinars. Remember, if you want to learn more about carbon accounting, that very first stream, we're traveling around the country in May, and there's a virtual webinar in June. So please come and join us for those masterclasses. Kevin, thank you very much for presenting with me. As always, fun to have you here. Always, I find it interesting the way you look at things. I look at it one way. Sometimes we are in 100% agreements, but sometimes you come with a slightly different angle, and then I learn from you. So I really appreciate that. I hope you have a lovely day. I hope everybody has a lovely day, and we'll speak again next month.
Thank you. Bye.